Hello everyone, hope you're doing well. It's been a while, and yesterday the Sensex fell by 2,700 points. We got a lot of calls from our clients. Some were worried, many were happy, looking at an opportunity. So we thought we'll make this video and share our thoughts on this topic of the market crash and how we can safeguard our portfolio. So some of the reasons for the fall, well, one of the most important ones currently is the Russia-Ukraine war. It's unfortunate that there is a war and due to which there is a fall. Next means inflation has been high. Many commodities are at record levels, fueling inflation globally. Expected rise in interest rates, be it US, be it Europe. India also very likely will start increasing interest rates in the next financial year. So going forward, we're looking at higher interest rates. Valuations had gone pretty high. So it warranted a correction and we're getting a correction. Another technical factor, many new investors who got into the market over the last 1.5 years, they're seeing a correction for the very first time. That can very well lead to further fall in the market going ahead as well. So as you said, there are two simple strategies that we are going to speak about as to how you're going to safeguard your portfolio and grow the portfolio as well. Firstly, don't treat your equity portfolio as an emergency reserve. We've always maintained that emergency reserve is very important. So maintain an emergency reserve outside of the equity portfolio. Think long term on the equity part. You'll automatically make good returns. Important, don't redeem equity funds for daily needs like car purchase, travel, helping a relative, other short-term requirements, because when the markets are falling and you withdraw, you end up making suboptimal returns. And from a investment point of view, would say don't go with the hype, don't go with futuristic stories, stick with quality and blue chips. Second, and equally important, don't track your portfolio too frequently. Do you expect that your portfolio will give you returns daily? Very unlikely, right? How frequently do you check your house price? Same way, on an equity portfolio, means I know of people who are tracking it hourly, daily, weekly, monthly. Even quarterly is actually too quick. Means we generally recommend a 6-month or annual portfolio check. If you're going to see NAVs and stock prices on a daily basis, well, it's not good for you, and it's not good for your portfolio as well. So your portfolio means we've, you can say, seen this. More you track, lower your returns. Of course, I'm not speaking about traders and genius investors. I'm speaking about normal people like us, me and you. Well, another thing, as I said, it's not good for your portfolio. It's not good for you as well. So impact of tracking your portfolio too frequently, heartbeat will go up and down along with the market. So we definitely don't recommend very close tracking of portfolios. Equity has proven itself over the years. There will be short-term volatility like what is happening currently. We'll get over it. There's absolutely nothing to worry about. Just giving you some of the past instances where we've seen market swings. Dot-com bubble of 2009-11. In between, there was a Iraq war, the global financial crisis in 2008-9, taper tantrums in 2013, Russia, Crimea. Just brought this up because there is a Russia-Ukraine issue going on currently. Mid-cap collapse in 2018, and then of course COVID 2019, which is started in 2020, and still we are in the midst of it. So we've had various issues. Each of them have been very different from the other, but one most important thing why we are so confident that we will get through each of these is that at the core of it, there is always fear and greed which is at play. Be it the dot-com bubble or mid-cap or COVID crash, whatever you see, it is, you can say fear and greed has really played out. So that's why we were pretty confident about things. So that's why Infinity will see you through 2022. 2024, we could expect another bout of volatility. 2028 going forward, any other issues as well that come through. So speaking about market cycle, the psychology and where we are currently. So I've just highlighted that according to us, we are at in between denial and fear right now. We've completed the euphoria in the market, and now we're more like denial, which will be wherein people will be like, no, markets will hit a new high very soon and things like that, which could be followed by fear and panic. So that's what our expectation is. We can definitely be wrong, and things can be very different in a few weeks from now, but that's what our expectation is, and that's how we are planning to position most people's portfolios as well. On the same aspect, quick warning for all of you. Last few months, we have been very lenient. Markets have been up, so we've been very happy and generous to let you redeem your money. Now, if the markets move as per our expectations, where we feel that it could be a, you can say, sluggish market for a few months, then the number of follow-ups that we do with you to contribute additional funds to your portfolio, though for most of you, we've got sufficient amounts in short-term funds waiting for this kind of a fall in the market, but possibly we will reach out to you for more as well. Just closing out with Warren Buffett and Jeff Bezos. We've spoken about this earlier as well. Warren Buffett says that nobody wants to get rich slow. That's the problem with most people, and well, because of this problem, many people end up losing a lot of money. So let's think long term, and let's stick with the asset class which has proven itself over the last many years to be the best asset class, which is equity and equity funds. Thank you. I hope you find this short video useful. More importantly, stay calm. Markets are doing their bit, and we will do our bit, wherein we will keep investing. Thank you.